All right, you got the stage.
Awesome. Well, thanks a lot, guys, for having me. Appreciate you guys having me on, and appreciate everyone jumping on here tonight. I know it's getting to be a busy time of year, but we're cutting time out late at night to invest in ourselves and our education. So hopefully we'll make this presentation worthwhile. Today, I want to talk about a topic that I think doesn't get talked about enough, but is something that every single investor needs to start to give serious consideration as you're evaluating your investments, as a sponsor, as a limited partner, however you're participating in investments. You really should be thinking a lot. And the name of what we'll be talking about today is CapEx. So we're going to talk about what CapEx is and how investors should think about it. So I will share my screen here. I put together a little presentation. It's probably not the most aesthetic thing you've ever seen, but I did my best on this. So hopefully it's sparks some good ideas, good conversation, and I love to keep it fluid, keep it open. As far as if you guys have questions throughout, be sure to let me know. But let's talk about this. And yeah, as Gonzalo hit on, for myself, my background's primarily in multifamily. I've done about 50 million in multifamily, and more recently starting to make some headway in the mobile home park space. My partner and I just launched a $10 million mobile home park fund, and we're planning to really dedicate a lot of our time and focus towards the space, as we see a big window of opportunity there. So I will talk largely about multifamily, a little bit about mobile home parks, and are your non-reoccurring expenses. So anything that is not going to take place every single month or every single year on a property would be formally thought of as CapEx, or capital expenditures. It starts to shift the way you think about it as you look at different size assets. At an institutional level, CapEx is underwritten very, very frequently, whereas at a smaller level or a lot of kind of mom and pop style investments, you're not looking at CapEx quite as much. But when you look at, I want to start off with the graph of this data point from 940,000 multifamily units. So when you look at this survey, it surveys 3,000 total properties that have individual meters, and then several that have master metered on the right. We can see sort of the operating expenses, and then you have your net operating income, and then at the very bottom you have your capital expenditures. So real estate investors, what do we focus on all the time? We focus on net operating income. How do we value properties? We value properties on net operating income divided by the cap rate, right? So we're constantly focused on net operating income, and that is thought of as our bottom line. However, there is often something going on below the bottom line, and that is your capital expenditures. Now, when you look at these numbers, these are not small numbers. This is a very significant amount of your total expenses flowing through a property. In fact, it's usually equal to, on a multifamily property, you're oftentimes around the 10% of your gross potential revenue or your gross potential rents is typically what you're going to find your capital expenditures to be. So we're going to cover what this is exactly. As far as what goes into capital expenditures on multifamily, you're looking at a lot of roof replacements. So you're looking at anything that does not occur every single year or every single month. You're looking at your roofs. You're looking at replacing siding. You're looking at updating the landscaping. You're looking at your window replacements, additions, major structural repairs, gutters. On mechanicals, these are your boiler replacements. These are your new water heaters, new breakers, plumbing up. Your bottom line, and OpEx is written off as an expense that year, whereas your CapEx is usually going to be amortized over the useful life, your deferred maintenance projects or any sort of obsolescence that's going to take place throughout a property. And then you have your cap value on the property to drive new revenues, to get a nice sale price, get a nice refinance in place, and so on. Now let's think about, there's a few ways that you're going to be able to fund CapEx. You can raise it up front. You can finance CapEx sometimes, You can fund your CapEx through your cash flow, and you can do a combination of ways to fund your CapEx. So there's pros and cons to each way. If you want to maximize your IRR, for instance, if you're focused on absolutely knocking the IRR out of the park and you really want to get the highest overall return on the deal, typically you're going to lean towards financing your CapEx through your cash flows, right? Because that means you're going to have you're going to have a larger or a smaller amount of total cash out of pocket going into the deal. And that means that you're going to be reinvesting your revenues into your CapEx, and therefore being able to improve the property without having to put a bunch of money out of your pocket day one. So that sounds all fine and dandy, and we all like to see a nice IRR in a spreadsheet. However, I would really think twice about doing that, because I think that's absolutely the most risky way to run a property. People are stretching to get into their first deal, and they're not thinking, well, why don't I wait until I have an additional 20 grand or 50 grand to put on the sidelines to be able to invest into some improvements or some of the deferred maintenance projects that are going to take place in the project, right? So oftentimes when you're going out and you're buying your first deal, you may find that you're going to buy it on a lean budget, and you may be reinvesting your cash flows back into the deal. But just know that I would definitely make sure that you have, at least at a personal level, some kind of reserves in place in case things come up, because they will. And you want to be prepared during those early years as you're improving the property or handling your deferred maintenance, that you have the necessary reserves to fund your CapEx projects. The option one, raising funds up front, is typically the most common way of funding your CapEx, and certainly what I would recommend. Raising funds up front means that you're going to be either if you're buying a deal yourself with your personal money, that you're going to be putting the proper funds into that operating account to keep those as your liquid reserves, realizing that when you have, say for instance, you plan on replacing the roof because it's a 15, 20-year-old roof and it's falling apart and it just needs to be replaced. You budget for that ahead of time. You have the funds sitting on the sidelines. So you want to go in and do some renovations and put some granite countertops in a unit and put in some LVP flooring and put in some new lighting fixtures, because you know that you're gonna be able to get $150 more on the rents. Knowing that you're going to have to do these, say it's a $5,000 turn on each unit, you're gonna budget the capital up front to make sure that you're going in there and you're doing those turns using the money that you've raised, not using all of your cash flows during those early years and running it extremely skinny. Option two, financing, is also a very attractive option, because if you can finance the CapEx, then you're going to get a cheaper cost of capital, right? Let's think about this from the sense of, what is the ROI on the CapEx dollars that you're putting into the property? If you are putting in, we'll go back to that example of a $5,000 investment into your unit to get a $150 rent premium. Think about what the ROI is on that. If you're getting $150 a month, that's another $1,800 per year. So that means that you're going to be able to recoup all of your initial investment amount in the first 3 years, right? So that's roughly a 30% ROI on that $5,000. I think that's pretty worth it. In fact, that's actually one of the most attractive pieces about multifamily. If I go up here, I have CapEx as a percentage of revenue. Multifamily demands the highest out of almost any form of real estate, and that's not always a bad thing. In fact, I look at that as a very good thing, because if you can go and get 20% or 30% ROI on your investment into your CapEx, that's a very substantial return, and that's why multifamily becomes a really attractive asset class to trade every 5 to 7 years. And you see a lot of that going on in the space, because every 5, 7, 10 years, a property needs updating, and that property can get updated usually one of two ways. You either are going to update it through selling it to the next buyer who's going to raise a CapEx budget and handle the improvements and bring it to life and maximize the overall value, or oftentimes you're able to refinance and use the refinance proceeds to reinvest back into the property. But you should constantly be thinking to yourself, how am I what kind of return am I getting on every dollar of CapEx that I invest? So if, back to this point, if you're financing the CapEx, then your initial, maybe your finance cost is 5%. A lot of the times, agency lenders will not finance CapEx, and they'll finance maybe a minimal amount, but I usually don't, even when I'm underwriting to agency debt, I'm not usually expecting them to finance much or any of the initial CapEx. This is typically more common on bridge loans, and I've also had it done with community banks that I have relationships with. So if you're able to get that money at 5% or 6% and return 30%, that's a pretty good spread, I would say, right? So I think we're going to take that all day long. And that if you can finance CapEx, you can maybe even have a lower threshold for the ROI you need. But if you're using your personal money, you may choose to not do certain CapEx projects because there's not quite the ROI that you would see in place. And then lastly, there's a combination, and a combination can be a smart way to finance your CapEx. In fact, we oftentimes are using a combination. Typically, when we are funding a deal, we're going to raise a substantial amount of CapEx for all of our deferred maintenance projects that we plan on doing right away, and for all of the unit upgrades that we plan on doing over the first few years. But along the way, we're also going to be refunding the CapEx budget with something called an operating reserve, a replacement reserve. And the replacement reserve, the lender required replacement reserve is usually $250 per unit per year. And I would suggest upping that a bit, especially if you're doing B and C class. I have seen the lender reserves go up to $350, up to even $400 at times. But if you put a substantial enough replacement reserve and you're constantly funding that year over year, then you're positioning yourself to be able to amply handle all of the CapEx expenses that will come up year over year, and position yourself to really be holding the property long term. So those are the ways to fund CapEx, and those are some things that I would be thinking about as you're evaluating CapEx. And I want to go back to discussing the different some different asset types and just things to think about as you're looking at CapEx. Now, right now I'm doing a lot of mobile home parks, right? And I've looked at probably 15 deals in the last week of mobile home parks. We have 2 under contract, and we're very busy with the space. Now, there's a unique opportunity there because a lot of these owners are mom and pop owners, and that means they have never really invested into CapEx. But with mobile home parks, a lot of times you don't own the homes, you just own the land and you just own the roads. So there's much less opportunity for CapEx. So when we go in and we install new lighting, we install a dog park, we install a playground, we upgrade the mailboxes, we fix up the roads, we install new signage, right? These sort of things that we'll go in and do. A lot of the times after that one heavy, or I guess it's heavy is even hard to say compared to certain things, but after you do that one first round of CapEx, there's limited exposure to CapEx ongoing, which for many makes that asset class very attractive. However, you don't have that same opportunity 5-10 years down the line. At that point, the property's stabilized and there's not that much for the next buyer to do. So they're not going to be able to buy it and be able to invest CapEx dollars that they can get 20% or 30% returns on, which will boost the overall sort of IRR and create this sort of value add opportunity. And the same thing can be said for self-storage, and it was very similar in that sense, where it doesn't have as much of the ongoing CapEx. So once you get a professional operator in there and they invest into the property heavily up front, a lot of the times they're just going to reinvest cash flows because it'll be a very minimal amount of ongoing CapEx. So it's just more than anything, I want to just encourage sort of a paradigm shift as to how you're looking at different asset classes and understanding, the role that CapEx can play. And I think that's why a lot of people are excited about multifamily over the last, especially, increasingly over the last 10 years, because everyone's waking up to the fact that this is an asset class that there's always opportunity in, because there will always be an old building. There will always be a building that doesn't have the improvements that will maximize the rents and bring up the market rent, because that's capital injection back into the property. So some questions to ask while evaluating your CapEx projects. I really came up with 5 questions that I think are really important to ask yourself. Number 1, is it necessary? Some projects you're just not going to be able to get around. If your roof is going to be caving in and it's leaking, I'd say it's necessary. So if your boiler blows on you, I know not everyone has boilers, maybe some that might be investing up in the Northeast or areas of the country that have older buildings with boilers in them, something like that takes place, you need to fix that, and you're gonna need to fix it right away if it's starting to get cold out. There's a number of issues that are just necessary deferred maintenance issues, or that just make the property simply obsolete to modern standards, and you're going to have to handle them. So you really want to make sure you do a thorough professional inspection on any property as you're purchasing it, and determining the items that are going to be needed to invest into with through either paying for it up front or paying it from cash flows that I could be taking home. Then what is my opportunity cost, right? I know if I know that my opportunity costs, I can get a comfortable 10 or 15% return on my money elsewhere, then I don't want to go and do I don't want to go and do a heavy interior upgrade that might only give me a 5% yield on that CapEx reinvestment, right? That would be the example of, if we invest that $5,000 into the interior, but it only gives us a $15 per month increase on our rents, it's probably not worth it, right? You might want to go put that $5,000 somewhere else that you're going to get a higher return. But if you're able to finance it, if you have a great relationship with your bank and they say, hey, we can extend this line of credit to you for 4%, 5% interest, and you say, well, I guess I can probably do a little bit better than 4 or 5% if I do some interior upgrades, and then maybe you'll find it's worth it, because maybe you'll say that at the end of the day, even though I'm breaking even as far as the initial yield on the 5% money that I'm borrowing, when I go to sell the property, I'm going to get a nice little value bump on that, so I'll take it. Or maybe you'll just look at it from the sense of, I'm going to have to do less work down the road, so I'll do it, right? So a lot of that depends on, your target return should depend on what your cost of capital is and what your additional alternatives to that capital is. Is it your highest and best use of capital? That kind of goes back towards that, but it also goes towards, let's think about, you might have multiple CapEx opportunities that you can invest into on your property, right? So you may have the decision to make of, do I invest into signage on the properties, or do I upgrade this one of our down units right now? You might say this down unit needs like $8,000 in upgrade to be able to get the premium that I want, or I can get signage in the property, and it might be a little bit harder to quantify, but the signage will boost the overall look and feel of the property across the entire board for all 100 people that live in my property, instead of just for that one resident that moves into that upgraded unit, right? So it's not completely black and white. It's definitely it's definitely tough sometimes to be able to make those kind of decisions, but those are the things that you have to think about. Where is my money best spent? If you have a limited CapEx budget, if it's running out, or if you're just trying to be lean on your CapEx, then you have to start to think about what the highest and best use is, and start to prioritize certain projects over the next. How will I finance it? As we spoke about, that's something you also want to make sure you're clear on. And how will it impact my taxes? So remember what we mentioned earlier, the fact that your CapEx and your OpEx function differently on your taxes. And so every time you're making a major decision, you should be coordinating with your CPA to determine, okay, if we're going to replace the roof, what is the useful life on a roof? So maybe they have to amortize it over a 10-year timeline, which means that if you spend say it's 20 grand, then you're going to be seeing $2,000 per year written off as an expense on your taxes on the amortized, expense. Or if you just repair the roof and you just do a $3,000 patch up, you're going to see a larger expense that year, and you're going to get slightly more tax benefits. I usually focus on this last, but it really depends on your situation as far as the ownership structure of the property and what your tax situation is, and if you have depreciation on the property. If you've already burned through your depreciation, you may be thinking differently about your taxes. But this is why I think this is another reason why I see a lot of sort of mom and pop operators that have owned a property for a very long time. They just run everything through their operating expenses, or everything that they're able to reasonably justify with their CPA as an operating expense, because they really want to lower their tax burden over time. So they're not going to sit there and make long-term decisions and try to amortize those things over time. They want to get them all written off as soon as possible. So that's really my blurb on CapEx, and that's sort of an overview as far as the things I would think about on CapEx. I want to get into any questions and answers.
Hey Dylan, I got a question here that actually somebody emailed me regarding. So I think it's very important to kind of make it clear between replacement reserves versus repairs and maintenance, as far as when you're underwriting properties goes. So maybe you could. You feel these two items are same thing, or is it kind of like slight difference between those two lines?
No, they're completely different, right? Your repairs and maintenance are your OpEx, and your replacement reserves are impacting your CapEx. What you're doing with your replacement reserves is you're taking that $250 per unit per year or more, which I suggest doing more. Unless it's like a brand new property, but even then, I would suggest doing slightly more. But when you're taking that money, you're oftentimes putting that back into your CapEx account, right? So you're refueling this CapEx account, which is usually going down substantially each year, right? And usually you're not going to refuel it as much as you're spending it. That's typically the nature of the beast as far as the way it works, especially if you're just taking over a property. So and remember, your CapEx account is going towards all of your non-recurring items, or your less frequently recurring items, as we spoke about. So if I go back up to examples of your CapEx, on each of these things, we have an alternative, which is your OpEx expenses. These are the things that come out of your CapEx account, but let's think about what comes out of your repairs and maintenance account. It is all of your, just like it says, it's patch and repair. I think an easier way to think about what I'm saying is probably to think about, is it a replacement or a repair? If it's a replacement, it's a CapEx item. If it's a repair, it's a repairs and maintenance or an OpEx item, and that's where it will show. So if you're just repairing the roof, that will be repairs and maintenance. If you're just repairing the siding, that will be repairs and maintenance. If you're just repairing or fixing up some of the landscaping, or doing landscaping, cleanup that takes place every single month, that is repairs and maintenance. If you're just fixing a window, repairs and maintenance. If you're fixing the gutters, repairs and maintenance, right? You're doing your ongoing boiler maintenance that takes place every month or every quarter, right? That's repairs and maintenance, right? So I can go down the list, but that's the idea. And even during your turn costs, if you're just touching up the paint, that would be under repairs and maintenance. If you're doing a completely new paint across the entire, say you're changing the paint color or just doing a completely fresh paint, that might be something you run under CapEx. If you're just kind of fixing up some of the cabinets, that's repairs and maintenance. But if you're completely new cabinets, that is a CapEx item that comes out of your CapEx account. So hopefully that clarifies it a bit.
Yeah, that makes a lot of sense. I think it's very important to kind of like differentiate between the two, because I feel like a lot of people get confused with those two items, but it makes complete sense. I mean, CapEx, you're looking at the big ticket items. It's kind of like what I from that, and then OpEx is stuff that you're fixing up tenants, things get damaged when people live in there. When you're turning apartments, maybe you got to repaint and everything. I'm assuming all that's got to be OpEx type stuff. But yeah, great. Thank you.
Mm-hmm. Do anything else?
Any questions, Adam, or good?
I think we got Tay had a question over there.
Oh, on the chat. Let's see. Sorry about that, Jerry. Let's see it here. When initially underwriting a property, do you have a per door rule that you apply to certain classes, BC, et cetera, and vintage?
No, yeah, that's a good question. I have a minimum amount that I would do on any property. Personally, I would never buy a property, multifamily property with less than $2,000 per unit per year allocated in a CapEx budget. And that would be, even if it was in pretty good shape, if say it was a B and C, and I'm mostly speaking towards B and C class. Honestly, I'm not going to be the guy to talk to about evaluating new properties because I really haven't spent much time evaluating brand new properties, and I expect most people on this call are looking at B and C stuff. But I would expect at least 2,000 per year, just even solely to serve as a contingency, because I can promise you, you're going to have HVACs break down. Those things are going to cost $4,000 a pop, each time. You're going to have to replace flooring pretty frequently. That's going to cost you $2,000 per turn, right? You're going to have all kinds of different issues you have. So I would never do less than 2,000 per unit. That's just my sort of minimum benchmark rule of thumb, but it largely depends on what you're trying to accomplish. Because if you're trying to go up to do, if you're going to do heavy upgrades, you might be at 8,000 or 10,000 per unit, right? If you're starting to restructure the layout of the units and take down, open up the kitchens and things like that, you're easily at $10,000 per unit, right? So you really just have to know what your game plan is going in and budget accordingly. And I'm not saying if you're going to do an improvement on every single unit, if you have 300 units, and do you have to raise $10,000 for each of those 300 units up front? No, you might budget for 65% of them, right? And you might figure you're going to do all the upgrades on the first year and a half of the of the turnovers, and then you're going to have a heavy replacement reserves that will be going back in to refuel, so that you can get the remainder of them as they begin to turn over. So that would be my thoughts on that, Jerry.
Awesome.
Let's see.
And on that, because this CapEx for us, when we're kind of like underwriting deals and trying to get get some good numbers. Obviously, the CapEx really depends on, like you said, like what type of improvements that you want to do to the units. What does it need? Granite? Does it need a different type of finish, right? Based on kind of like the area. How have you done it before as far as estimating? A lot of times we talk about where like your property manager, that should be the first person you call to kind of give a very rough approximation of what it would cost to, granite, like you said, maybe vinyl flooring and replacement of bathrooms. How are you doing it, like as far as like estimating, CapEx on renovating units? Yeah.
So as far as the estimates are concerned, I self-manage the properties that I'm operating now, and even with my former company, we self-managed. So we were able to keep a really, really good pulse on that, and we would really just bid out. So we knew no matter where we're buying a property, we kind of know like our 2 or 3 unit schemes as far as the type of flooring we're going to use or the type of paint we're going to use, right? We kind of know what those costs are. I would say if you're moving in and working with a third-party manager, they're going to have their own way of doing it. So you just work with your property manager, and they should have an idea as to what sort of upgrades, what kind of budget to put into the upgrade. But to your point, Gonzalo, about you don't always know what's going to produce the ROI, right? On a spreadsheet, we all like to say, yeah, I put in 5,000, I get 30%, and it looks great, and you know, it's a cash flow machine, right? But in reality, we have to see what the market's going to accept, right? You might put that 5,000 in and say, and realize that even though the comps down the road had these upgraded units that were doing better than yours, for whatever reason, people don't like your place as much, and you put that 5,000 in, and they're not willing to pay, they're not willing to give you the 150, they're only willing to give you 50. So you have to be ready to pivot. So I really encourage sort of a test and measure approach where you're gonna try to see what the maximum you can get is, the maximum ROI, bang for your buck is, and maybe do a few high upgrades, a few light upgrades. And if you find that the light upgrades are leasing up almost equivalent to what your heavy upgrades are doing and you're spending half as much, then maybe you roll with the light upgrades. And the beauty of doing the light upgrades is that when you go to sell it to the next guy 5 years from now, you're gonna be able to sell it to him and say, well, you can do these heavy upgrades and get even more than I'm getting, right? You leave a little bit of meat on the bone for the next guy. So if you're not sure about whether to go light or heavy, I would probably go light, because you leave meat on the bone if you plan on exiting the property at a certain point, and you always have the opportunity to go heavy down the road, right? So those are some things that I would definitely really think about, and don't have such a, I think one of the problems with the real estate industry, like comparative to, like, if you take like you know, the sort of like the technology space, there's a lot, like it's really promoted heavily to kind of test and measure things and try and see what sticks. I think in the real estate space, we go in with these pro formas and we think we have to stick to them to the T, but in reality, it doesn't work like that. So you have to be ready to, you have to be flexible. You have to be ready to sort of try things out and test what your ROI is and see what works well for you, and be ready to pivot if needed. And hey, the best thing that happens is you raise too much money, right? If you raise too much money, all you have to do is decide 6 months in, 12 months in, I'm going to do a return of capital. I'm going to send back 200 grand of the 500 I raised, because we're just not going to be able to put into work at a level that I need to. And investors are not going to be that upset of getting 10 grand back of their 100 grand because you raised too much money because you were trying to take proper precautions on the front end, right? So I would always overraise versus underraise, because if you underraise and you realize that this thing's going to suck up a lot more money than you thought in those first few years, and you're going back to your investors saying, hey, we ran the budget too lean, we need more money from you guys, that's what's going to piss people off. So I would definitely be making sure you're raising more than enough money, and you build in a proper contingency.
Yeah, that's a great thing. So test run the upgrades. I like that.
Yep. And I think Tay had a question here about, where single family stacks up against other classes, and as far as CapEx as a percentage of revenue. So Tay, I would say to that it's probably very similar to multifamily. I would actually expect it to be slightly higher than multifamily because you have one roof on the one unit, right? So you do get some economies of scale when it comes to some of your capital expenditures. When you're looking at multifamily, you're only going to have to replace, if it's a boiler, like we talked about, one boiler for the whole, building versus for the one house. On single family, a lot of times you have septic tanks. You don't have that as oftentimes in multifamily. That's a big CapEx that really adds up. You have that, the one roof to replace. You got a lot of landscaping for that one unit. So I would think that as a, CapEx as a percentage of revenue is probably the highest, but you're only going to see that on an underwriting for oftentimes like an institutional group a lot of the times, right? The way I see, like with a lot of single family, people are just underwriting the deals as the all-in expenses are what they are, and occasionally my HVAC breaks and I gotta make up for that, or occasionally my roof needs to get replaced. But a lot of people aren't underwriting. They don't usually open up a separate bank account to have, like, this is my reserve account for my single family. It's usually all just kind of flowing through the same sort of operating statement. So that's just something to think about. But I think if you're starting to kind of be thoughtful about what your CapEx is, and even just on your accounting, if you're managing a single family in QuickBooks or Buildium or whatever accounting software you're using, and you really start to even create a separate GL code specifically for those CapEx items, and you start paying attention to that, it's going to help you, because you're going to be able to go back and realize that even though you had to replace your septic and your heater, water heater that year, it really wasn't that bad of a year because your normal operating expenses were operating better than your CapEx was. It was just a bad CapEx year. So next year you should be in good standings, right? So you just got to start to think about things along those lines.
All right.
And then
Yeah, a lot of times, the good thing is with single family, with oil tanks, you can finance that stuff. You know, you can finance a lot of these stuff. So as long as you fit within if you can fit into your budget, then it works. You know, but there's a risk with oil tanks, as you know. You just don't know.
Oh yeah.
yeah. No, that's a good point. Yeah, and that goes back to the cost of capital. If you can finance it, especially with where rates are right now, we'll do that all day, right? So you know, it's cheaper cost of capital. It always makes sense. Jerry, you mentioned when owners drop CapEx and R&M, it sounds like determining what was a replacement or repair is always a way to reconcile this. How do you recommend researching this when dealing with mom and pop owners? So I'm super glad you asked that. I think it's a great question. So I love buying off mom and pop owners, right? I don't like buying off these sophisticated institutional guys that have a whole separate CapEx budget and all these things are hidden below the line, right? It's a pain. Frankly, it sucks because you have to really determine, are they, every time they paint a unit, every time they're putting new flooring in, that's not showing up on their operating statement. You know, what are their real all-in expenses? How much CapEx are they spending? And it's sometimes hard to get a pulse on that. They'll try to fool you with, accrual, it's all accrual based accounting, right? And you have to really dig into those accrual statements that they send you as their P&L and determine, okay, what kind of CapEx stuff is not on the statement that I'm not seeing that's going out each year. You also have to dig into, what are their true collected revenues versus what's been written off, because sometimes they don't write it off all the time as they should as they're trying to sell a deal. So mom and pop owners are the best. And I love, I think it's much easier to reconcile this when you're dealing with mom and pop owner because you can simply just go through their statement and it's going to be transparent as day. Usually they're going to be on a cash statement instead of accrual, and you're going to be able to see every single dollar that goes out and exactly when it went out and exactly what it went out for. And oftentimes your budget's going to be able to be ran a little bit more lean than theirs, but you're also going to have this capital expenditure account that's set aside, hopefully up front, to be able to finance some of these bigger items that are taking place. Or maybe they're not replacing or anything and you realize that they're just doing a ton of repairs and they're just kicking the can down the road, and you're about to take over a property that's going to be a ticking time bomb, and you're going to have to replace every single HVAC because they've just been trying to repair these things every other month or something like that.
Yeah, just trying to bandage it up.
Yeah, which everyone does to a certain degree. And I'm not saying you have to replace everything all the time. You definitely shouldn't do that. I definitely try to repair as much as possible until necessary with certain items. I don't want to replace a roof right away if I don't have to, right? I want to get the most out of that useful life and just do repairs until it gets just out of hand. Same thing goes for a lot of the HVACs, right? There's certain items you don't want to just go in there and replace all the time. You got to watch it.
Lipstick on a pig expression.
Yeah. Exactly.
All right. I don't think if nobody else has any questions, Adam, you good?
Yeah, no, it's great. Learned a lot. Thank you.
Of course.
Wow.
Yeah, I think this is a super important topic, Dylan, especially for us guys, just looking at these type of properties, trying to get a grasp on CapEx, repairs and maintenance. And I think with the breakdown you gave us, it clears things up a lot, as far as like what money and what buckets you need for types of repairs that are going to be needed.
Yeah, I like the idea of over budgeting just in case. You just don't know for unexpected things, because if you're writing a lean budget and you're hoping cash flow is going to cover and Corona hits, what are you going to do?
Yeah, exactly.
Yep. No, exactly. It's you definitely want to be prepared, because it always looks good on a spreadsheet, but when you get in there, shit happens, right? Things will come up and that you don't expect, and you gotta be forth. So it's always building a little bit of a contingency so you're prepared for the worst. And I just threw my email there too. If anyone has any questions, or if you're unsure about things or anything we didn't hit on, you can definitely feel free to reach out.
Yeah, thank you.
Yeah, so Dylan, this is gonna be recorded. We'll send you the link for all that information if you want to, post it up anywhere. More than happy to. So give us a couple of days. But and thanks a lot, man, and lots of luck to you with the different types of projects you have going on, and especially the mobile home park stuff. It sounds pretty interesting.
Yeah, definitely.
Awesome, guys.
All right.
Well, thanks.
Yep.
Good stuff.
Take care.
All right.
Take care.
Nice seeing you.